So stocks are holding on to big gains on hopes the Evergrandes debt crisis can be contained in China. Investors are also digesting the Fed's move yesterday, like Bob was discussing, the signs of movement in D.C. towards an agreement on the big spending bill. But is it really clear sailing from here? The Wall Street Journal this morning reporting Chinese authorities are asking local governments to prepare for a possible storm, indicating their reluctance to further bail out Evergrande. My next guest says this is what will shape global economies and markets. Joining me now is David Rosenberg. He's president, chief economist, and strategist at Rosenberg Research. David, it's great to have you here. Could you just first offer some observations about this rally that's shaping up over the past, I guess you could say, near 24 hours going back to the Fed, but maybe it's even before that going back to what looks like the Chinese dealing with the Evergrande issue?
Right. Well, I don't think that you could really look at the stock market's movement in the past couple of days without looking at it in the context of what happened earlier this week. It's clear to me that the vast majority of this rally is a relief rally. It is based on redressing the early week concern that Evergrande was going to be a Lehman moment. I mean, you know as well as I do, almost everybody that came on CNBC that day was addressing whether this was going to be a Lehman moment. And we know now that it is not going to be a Lehman moment. There's a greater understanding as to that this is all domestic debt. The amount of foreign held debt is very low. And I think there's just more confidence now, and it could be tentative, but there's confidence now that Beijing is going to step in and smooth this demise, or maybe even nationalize Evergrande. So the market's just done, what can you say? It's just been a roller coaster ride. Right. But to me, this is largely based on Evergrande today.
But you're saying it's a relief rally about the direct knock-on effects. But do you still think it's an issue? You know, when I look at what you've been writing about, you're sort of warning people that it will slow China's economy. That is going to have kind of an indirect effect on growth. So what does that mean for stocks, and what does it mean for bond yields, which, you know, like Rick was saying, their move has been possibly even more dramatic here?
Yeah, well, look, the reality here is that even before Evergrande was making the front pages of the morning papers, the Chinese economy was slowing down precipitously. I mean, between April and August, retail sales in China are down 20% at an annual rate. Yeah, that's negative 20. Industrial production is negative 8%. Property sales, even before this fiasco, were down 20%. I actually think that there's a very good chance that China is double dipping. What's the net impact on the U.S. economy? It's not that big because the U.S. economy is a large, basically closed economy. And as big as exports might be to China as a share of the economy, it's very small. So the direct impacts aren't that big. And we saw that, look, when we had the Asian crisis, which began really in July 1997, I'm old enough to remember that, it didn't become a big problem until long-term capital about, well over a year later. It never had a direct impact on the economy, had an impact ultimately on the financial markets. So the point I'm making here is the knock-on effect, when you think about what China is really important from a macro standpoint, it consumes half of the world's basic materials. So to me, this is a big question mark over the big reflation commodity trade. Sure. I think a Chinese big slowdown recession is going to unwind that. And so that's where I think the big impact is going to be.